Money Sense, bringing an informed financial perspective to the Cayman community.
A very good morning and warm welcome once again to Money Sense. I'm Simon Cawdery and I have the distinct pleasure of re-welcoming Richard Maparura to the show. Richard is a senior portfolio manager at Butterfield Bank and is also the most recent past president of the CFA Society Cayman Islands. So Richard, welcome back once again. Almost exactly 12 months since your first and last appearance on the show.
Thank you, Simon. Thank you for having me. How timely, how timely.
Indeed. And 12 months ago, we were talking various economic matters. And today, it feels as though we haven't necessarily progressed in our understanding or our interpretation of a lot of those economic matters. A lot of the topics we were talking about then were interest rates, inflation, and possibly, or not possibly, probably the biggest topic of relevance right now because it impacts everything else is inflation. Inflation has been incredibly high. Everyone has been suffering in the Cayman Islands with higher prices for almost everything. And we're starting to see, some of the evidence is some of the tides of inflation are turning. Perhaps it's seeing lower numbers. So give us your perspective on what you think's happening with inflation and what you think's going to happen with inflation.
Yeah, no, I think there's been some progress on the inflation front if you look at just on the headline numbers. So if you look at the biggest economy, obviously the US, I think last year, 2022, we saw high numbers close to 9%. Mm-hmm. At the moment, we're looking at about 3%, which is quite encouraging. But I mean, the fight against inflation from a monetary perspective is not yet over. I think that's what's the most important thing to bear in mind, that the target for those who are fighting inflation on our behalf is essentially a 2% target, right? We are not using the 3% number essentially because they look at a different statistic, which is close to double what they are wanting it to be. So there has been some progress on inflation, which is quite encouraging in terms of headline numbers, but there is still a path that needs to be corrected to bring down that inflation number to where it's supposed to be. But at the same time, things continuously get moving, right? So if you look at oil at the moment, it has started picking up again, right? So we saw it at the lows of 65. Now we are back up again in the 80s. So inflation can start to creep back up again. So those are things to look at and just to anticipate where things can move on. But the fight against inflation hasn't stopped.
Look, I'm an economist by training, so I'm going to pick on economists and in a sense by saying, take the other side of this argument and say, look, pretend I'm not an economist, pretend. It seems as though economists are always saying, well, you've got to hit this magical 2% number.
Right.
But 3%'s a lot less than 9%.
Correct.
Can't we be okay with 3%? Why is 2% so important? Why do we have to continue doing stuff which is going to sacrifice jobs, continue to make people's lives tougher by putting up mortgage costs? Why is 2% such an important number?
Yeah, I think that's a fair question, and I think that is really where the crux of the market is at the moment. If you look at the pricing of the market, really, if you use what we call break-evens in the market, you look at the five-year inflation expectation from the market perspective now, it's close to 2.5%.
Which is close to 2.
Which is close to 2, but also close to 3. Yeah, okay. All right. So what the market is saying is that maybe we don't need to stick to this 2% number per se, right? So a 2% number is really a number that the central banks came up with as a good target that balances between, because you need a little bit of inflation for an economy to be growing, right? But how much of the inflation do you need? That's where we got that 2% number. So the 2% number was a number that was, this is a perfect number to target so that we have growth at the same time. We have some inflation, but not inflation that impedes the spending for the consumers.
There's also the argument, of course, that the tool that the Federal Reserve uses, or any central bank uses, to control inflation is interest rates.
That's correct.
And in many countries, people might have their car loan or a house loan, and those are on variable rates, so that when the central bank puts up interest rates, you start to feel the pain immediately.
Yes.
But in other countries, the US is a good example of this. A lot of people who have mortgages that are on fixed rates for a certain period of time.
Yes.
So the Federal Reserve puts up interest rates. Someone with a mortgage which is fixed for 5 years and might have 3 more years left have felt no pain because of these interest rate rises. They felt no impact because they've been paying the same rate for the past 2 years and will continue to pay it for the next 3. So the argument, I suppose, is that what the Fed's done is still going to hurt people in the future. It hasn't yet, the full magnitude of it hasn't necessarily been felt because a lot of people have been on these fixed rates. So it could get a lot worse for people when these things start to have to be refinanced. So in other words, yes, inflation might now be a little bit above, but the lagged impact of what the Fed's done is going to hurt people in the future. So
Yes.
why don't we just give it a bit of time, let that play out, rather than make things dramatically worse?
No, I think you put it rightly, Simon, because if you look at the US, I think about 89% of the financing in the US is on fixed, right? About only 11% remaining is on variable. So yes, the immediate effects are not felt really for the bigger or the larger population in the US. But you're right, mortgages have gone up from 2.7% during COVID, 7% now for anyone who wants to buy today. Credit cards have gone up 14% to 21%. Credit cards are on a day-to-day basis. So anyone spending on the credit card, they're going to feel the impact, right? Car loans have gone up 4% to 8%, so almost double. But again, it's a global perspective if you think about it. There are countries like the UK, Canada, Australia. These are big economies. Those places, their mortgages, the larger book of the mortgage is probably just on a 2-year. And those 2 years have almost passed. And everybody who's refinancing now, they are feeling the impact. And that's the mechanism, really. It's a pain and a gain sort of like game. It's putting in some pain so that we get the gains of reducing demand so that inflation can come down. But you're right that there will be a protracted sort of like time to get the full impact of these sort of like rates that have been pumped out by the central banks.
So sometimes when I think about what central banks do is that they have huge volumes of theory which say that interest rates happen with a lag, they impact the economy with a lag for exactly the reasons you're giving. Everyone studies that, everyone knows that, it's
Yes.
factual knowledge. And then they sort of behave in a way which is, well, the interest rates, inflation is 3 or 4%, therefore we must continue raising interest rates. We must panic about this because it's not yet where we want it to be precisely.
Right.
So it feels as though central banks totally understand their theory and then do something completely opposed to what their theory tells them. They should be a little bit more patient. Do you worry about that?
I agree. I think, let me explain a little bit what they usually try to do, which I think at the moment they've achieved, but, in courts. So what the central banks are always trying to do is that they want to try to have rates into what is called a restrictive territory. A restrictive territory is when the rates that the central banks have out there are higher than, at least if you want to call it, the nominal interest inflation rate. And that has not happened since they started increasing rates. It has only happened a few months ago, where we now have for example, the central bank in the US is now, rates are 5.5, right? Whereas inflation is probably, call it 3%, call the PCE 4%. So now we have their rates slightly above the inflation. That's where they want to be. If they get to that point, they want to stay there and say, now we are restrictive. We are choking the economy, essentially, technically, right? And that's a place that takes time. So if you think about inflation being this high and they're trying to ride until their rates go above, that really sometimes might seem as if they are acting in a bizarre manner because they are chasing a certain number.
Exactly.
But now they're getting to a point where they're saying, look, that's why now they're talking about wait and seeing, being patient. They've delayed a rise in June. They skipped a rise in June because they are now seeing that they are now in that territory. So in a way, it could be confusing, but there is a certain objective that they would want to do, and that's where they are at the moment.
Going off on a slight tangent here on a very theoretical point, but there's a school of thought in the economics profession about something called nominal GDP targeting, whereby you don't adjust interest rates to inflation, you adjust interest rates to achieve a certain nominal level of growth, because nominal incorporates inflation.
Yes.
And I guess just as if for any listeners that are particularly interested in different views on how to control or how interest rates could be used, just encourage you to do a bit of research and read about that, because it's a very interesting theoretical perspective which has been talked about by some central banks as to in a different approach, because especially when you had something like COVID where GDP went down so much, there's a lot of slack left in the economy. And yes, we've had a lot of inflation coming back from COVID, but it's not because there isn't slack, it's because of supply constraints. And sometimes theory needs to evolve because of changes in understanding of economies, frankly.
Yeah, no, that's right.
So you've talked about the delays, you've talked about the wanting to choke the growth rate of the economy. Are you thinking, therefore, that we are at the end of the hiking path of interest rates? Do you think central banks, let's take the Federal Reserve as the most talked about?
The most, yeah.
Do we think that they've given up for this year and that's the last of it? Or do you think there might be another one, or dare we say two?
Yeah, that's a very good question. I think it's always good to err on the side of caution. And the caution there is just to follow and listen to what the Fed is saying. They're saying there's probably one more to go. Mm-hmm. And they are saying that every meeting is going to be live. I think that's just a nice way to put it, right? And I'm in the camp that I think there could be one more, but we are almost at the end than where we started.
A lot of market analysis right now is saying, okay, there might be one more, or potentially there isn't, but let's assume there is one more this year. But because of some of these lagged effects, we could then find ourselves in the bizarre situation where the Fed, quite early next year perhaps, starts having to cut interest rates because suddenly we see economic growth being quite weak. We start to see people worrying about inflation. We're starting to see profit margins coming under some pressure. We're seeing companies starting to talk, haven't been talking about that for some while.
Yeah.
Do you think we could be in that quite odd situation where not long after the Fed finishes raising interest rates, then they start cutting, almost validating the discussion we just had, which is they behave in this somewhat quirky cyclical sort of fashion?
Yeah. No, I don't think so. I don't think the Fed is going to cut rates quickly, to be honest. I think they're going to err on the side of caution. The last sort of template that they are using is really coming from the late 1979s into 1980s, where we had, the Paul Volcker period, where we had so much, in terms of inflation. There were mistakes of stopping early and inflation relapsed again, and then I don't think they're going to cut rates early. If they cut rates early, they're celebrating a victory over inflation fight, which might be premature, right? So I think they were going to take their time. The other reason they might then cut rates, which is what you also mentioned, is that maybe we might actually get a recession, and maybe then they would have to cut rates. But that's an exogenous thing. If a recession comes in, then surely they would have to cut rates. But I don't think they're going to cut early on the basis of celebrating a victory over inflation fight prematurely.
So just taking that then into what that means for the person on the street, the person listening to this show, that means that they've got to brace themselves for the costs that they're incurring right now in their mortgages, their car loans, their credit card bills. They're not going to get any easier for potentially another 12 months or so.
I think that's a fair way to put it, painful as it is, but I think that's a fair way to put it. So there is something called the dot plot, which is essentially something that tells us the thinking process of the voting members. And I think the voting members using the Fed per se, they are suggesting that only until the end of 2024, maybe that's when we might see sort of like 100 basis points cut, but not before that. I think we have to brace ourselves, at least for the next foreseeable future, which is about 12 months, for higher rates.
And you mentioned the recession word. I suppose I first of all mentioned it, and then you bravely used the word again. Do you see much chance of that? When you read what you're reading, what you're seeing from commentators, do you think that's something that's a risk that we all really need to be much more aware of? Because recession has really bad connotations. It has people are going to be out of work, people are going to start losing their jobs, people are going to be suffering in ways that will make these high inflation periods look, in hindsight, quite pleasant. The fact that our cauliflower in the supermarket or our vegetables has gone up to extraordinary levels, and genuinely have, that's as painful as that might be. If you have a job, you can just about afford it. If you don't have a job, it's a much more difficult situation. So do you worry that inflation is a real risk or not?
Recession,
right? Pardon me, yes.
That's right. It is a risk. It is a huge risk, to be honest. Fair enough to say that we are in a territory where the economy hasn't been. We are in a level of rates where the economy hasn't been in a long time. We can surely understand that there's a stretch on credit creation. Essentially, we're talking about how borrowing is now becoming expensive, right? But at the same time, there is a huge contribution. If you look at the U.S. economy, the biggest contribution to the GDP, which is part of recession, right? When GDP goes down, 70% is consumption. Right, and consumption is really coming from the individuals. Most of the individuals had so much savings from COVID. They've been dwindling down now, but they are still there, right? If you think about wages right now in the US are increasing at around 4.4%, which is a haircut above where inflation is right now. So real wages are still positive, right? So there is still some life in terms of the consumer, which is actually the biggest contributor in terms of GDP. So there has been this dynamic that the job market in the US, all times low, 3.5% unemployment. So people are still employed at the moment, right? So there is still some life support, which is kind of like kicking in. But you're right to the point that if this continues and then the powder dries out, surely we might start to see a slowdown. Surely we might start to see more companies complaining about, cost of capital. We've already seen about 340 companies going bankrupt this half year only, which is, not a very good sign. But if that perpetuates and rates continue to be higher for longer, we might surely get down and get to a point where GDP starts to slow.
So you mentioned something there which I just want to, just before we're going to go to a break very shortly, but I just want to come back to it, because you mentioned about the savings rate and how during COVID people saved a lot of money.
Yeah.
And I totally agree with you. Funny enough, before coming on the show, I was preparing for this and I dragged out of Bloomberg the personal savings rate. And it's come down a lot since,
Yes.
Since COVID, it's come down naturally because that was unexpectedly and unsustainably high. But it's now at levels that are much lower than we were for the decade before COVID. So actually, what that tells me is that consumers are certainly spending, but they're living quite a tight. They're working on quite a tightrope in the sense that they haven't got a huge buffer of savings compared to what they had because of all the costs that have gone up.
Yeah.
So although consumers are spending, it's quite a delicate balancing act that's being taken by consumers, right? And it could very quickly tilt the wrong way if the wrong sort of thing happened.
It can, and I think that's where the discussion of how high for how long is it going to be, because if it stays a little bit longer, it becomes more stretched, and then surely something might break.
Well, look. On that note, we're going to take a quick break. Please do stay with us and join in the conversation with Richard Maparura in about a minute's time.
On a daily basis, making it easy to connect with you, our listeners. Add us to WhatsApp today, 925-3261. That's 925-3261.
Radio Cayman.
Send a text or voice note.
Can I send a request, please?
You don't really have to ask us. Just send a request.
This is a shout out to my ex.
Radio Cayman, the voice of the Cayman Islands.
Radio Cayman, maintaining the innovation.
This is
Money Sense, bringing an informed financial perspective to the Cayman community. Brought to you by the CFA Society Cayman Islands.
And now, more Money Sense.
Welcome back to Money Sense and our conversation with Richard Maparura, Senior Portfolio Manager at Butterfield Bank. Before the break, Richard, we had a detailed and very interesting conversation on where we are in terms of inflation and recession. Connected to that, of course, intrinsically is debt, and also other countries. Other countries have potentially lessons to be taught for us in terms of, you take, for instance, Japan. They've had decades of their zero interest rate policy because they've had disinflation. They've had long periods where they've struggled to see any economic growth, and we had very low interest rates in the US for a sustained period of time, and Japan's been trying to generate inflation, and we're all now panicking here in the US, in the UK, and Canada, and Australia, as you say, about inflation. So what's going on over in Japan? Let's just talk about that.
Well, Japan is actually a very interesting country, Simon. Right now, fun enough, the inflation in Japan is actually more than the inflation in the US. Can you believe that?
Yeah.
Which is funny. But they've been sitting on negative rates forever, I think, like now since 2014 or so. So Japan has been a classical separate story from where everyone else is, right? But recently, the reason why Japan is important, if you think about it, is that obviously it's a G7 country, but their GDP is number 3 in the world, right? This is just after the US and China. Even though it's about $4.something trillion, China is quite high, 19, US 20-something, but Japan is number 3. And why is Japan so important in whatever they are doing is that Japan is actually the biggest holder of U.S. treasuries outside of the U.S., right? So they are the biggest holders. They hold about over $1 trillion in U.S. treasuries. So whatever they do in their economy, right? If you think about the Bank of Japan, government bonds, the controlling that they're doing. So right now what they've done with their yields, if they've sort of like allowed it to move a little bit more flexible up to 1%, the threat is that are Japan investors going to see that as a good return and then decides to sell the US and then buy the local, right? And yet they are the biggest holder for US treasuries. What is that going to do to the US market? So that's why Japan is really an interesting story in all these dynamics.
So what you're saying is that over the last decade or more, in actual fact, because if you deposit money in a Japanese government bond, you know you're going to lose money because it has a negative rate of return.
Right.
That seems to be, well, not many people are going to make that bet. That's not a desirable bet, because the best you can do is to lose money. That's the very best you can do. The other option was to invest in a different country where you could lose money because of exchange rates, but you might be able to make money because the yields are positive.
Yes.
Whereas now the Japan investor has, well, Japanese yields are positive, so the best I can do is make some money. And so potentially they could start selling US government debt, and we definitely want to talk about US government debt. But starting to sell debt means that yields on it start to go up more. And that makes the problem then of the US government's ability to finance itself and to sustain its own budget deficits, which, as we know, are problematic. That makes it more difficult, because if the cost of borrowing by the US government goes up, they're already borrowing over 100% of GDP.
Yes.
That raises the question as to what Moody's recently downgraded, Fitch downgraded, 4 or 5 years ago, or more actually. So people are starting to talk a little bit more about, is the US government good for its bills, kind of thing.
Yeah. I mean, I think you spoke about a lot of things there, but that's exactly what's going to happen. And we've already started to see a lot of spike if you look at the long end of the curve in terms of yields, we've already seen them start to move. There are two reasons. Obviously, the first reason has been maybe the fear that maybe Japan will start to sell, and we've seen a spike. Or one of the biggest drivers, obviously, has been just the issuance that the US is doing to just raise more money to cover for the gap, right? Because as soon as the debt limit was lifted, they need to get the money, right? And the US is eating actually more than that. It's what it is hunting, which is a big problem. You mentioned an important point about yields going up and how that can affect the US. It's a terrible thing, because right now the US is close to about paying, if I give you this number, you might be shocked, close to be paying $1 trillion in interest payments only. It's now higher than the US defense expenditure for the year each time they're paying these interest. So yes, that's why I think Fitch came in and then say, okay, look, things are not looking very good. I mean, Fitch was led to the party, to be honest, fair enough, but S&P has already done that a long time ago, right? 2011, and now these guys come in, fair and fine. But what has also happened is that really, if you look at the credit spreads between the one-year credit spreads for the US, they didn't really move that much when Fitch came in. Why? Because I think Fitch was just endorsing something that was already there. So in terms of, do you still think that you can still allow the US to lend to you or buy treasuries? Probably yes. Did it change between Fitch and credit downgrade? Probably not.
I guess part of the analysis, and I think a lot of people have become excited about the downgrades that rating agencies place on government debt. But in reality, if the US rating were to be cut from AA+ as it is now by two of them to A-, at the end of the day, what would really happen? Because the US is still going to pay its debts, and if it doesn't, every other asset class is going to be a lot worse. So there are much more material problems than not being paid back by the US government if the US government is not going to be paying back its debts. That is just a symptom of a problem. But if the US government isn't paying its debts, then there isn't going to be much profit being made by US companies, because there's going to be huge problems in terms of just being able to operate, because the US government's going to be saying, well, we need to raise taxes, we need to do this, we need to. It would be a truly dysfunctional economy.
That's a very good point. And I think the only time we can see that sort of like playing out is, think about pension funds, these big pension funds, and some mandates that are just very restrictive, right? So some mandates might just say you need to invest in AAA. Right. So it simply means that if someone is supposed to only invest, if it's a pension fund is supposed to invest in only AAA, then it means they cannot invest in the US when the US is AA+ or AA-, right? There's going to be so much just liquidity issues, it's going to be very difficult. But there is still an expectation that even an AA+ today and a AAA on the US, so far hasn't really changed anything in terms of the US's ability to pay back its debts.
I think from an investor perspective, I think there's a distinction with certain countries, not all, certainly, but with certain countries that the rating of the country is mostly irrelevant because it will be doing it. Whereas the rating of the companies within the country, that's where you need to pay more attention to.
No, for sure.
The rating agencies. So the rating agencies have downgraded the banking sector in the US in a broad terms because of the worry that you started talking about earlier before the break about, well, people are paying higher costs and perhaps they can't afford it. And so then you start to see defaults rising, and then you start to see banks having write-offs and problems in that sense. So I think rating agencies do a very good job, a very useful signal when it comes to companies. But rating the US or the UK or Canada doesn't really make much difference.
Completely agree. And that's why we talk of, the credit risk rate for the individual companies compared to sort of like what we use as the risk-free, which is the government bond. So essentially rating countries, I think it's a tall order, to be honest, especially if you're de-rating the US. I think, I don't know.
I mean, rating countries that don't have stable financial systems, whether it be a Venezuela, for instance, or Argentina, there's information in there that is useful.
Yes.
I think that's the distinction I would draw then. Rating AA plus or AAA or AA minus, at the end of the day, you go, nah, who cares?
Yeah.
So all that said then, Richard, markets. We've had a pretty decent 2023. I'd almost got the year wrong there. I had to think that one quite seriously. We had a pretty decent 2023. Despite all that we've been talking about, interest rates have gone, in some respects, from record lows to not record highs, but the record delta of change. It's been pretty quick, and the magnitude of that. What's going on then?
That's it. That's always an interesting question. But I think the short answer and the long answer to that is that's why we always encourage investors to stay invested, to be honest, right? Because to try to time when it's going to happen, when it's going to be, we had a big drawdown in 2022. Now things are coming back in 2023. The S&P is up almost 17% year to date. Very good. And this is a year to date return. Compare that to an annualized return on the money market of 4%. That's 2% against 17%, right? So the market has done very well. There's been a worry, though, on the sort of like the market performance, that it has been concentrated on a few number of stocks.
In a lot of technology
companies. Right? Yeah. So AI has sort of like driven, the Nvidias of this world, and we have seen about. Now we have the magnificent seven, right? Sort of like driving the performance. But that's not very unusual in terms of the market performance. And we have actually started seeing a broadening of that sort of like performance in the market. The market is always forward looking. The market is always trying to be ahead of, the immediate data. And that's why most investors cannot try to time the market, because you're always going to miss these shows if you're anticipating a recession beginning of January and you lose out on 17% on S&P. To cover that gap, it's going to be almost impossible.
So you rather elegantly and skillfully dodged my question completely by saying where the market's going, by saying just invest and ignore the market movements. I totally agree with that perspective, but very elegantly done. Look, I think we're coming very close to the end of the show. Are there any final sort of thoughts that you have or warnings that you have that you want people are there areas of the market or areas of the economy that you think people should keep an eye on that we haven't discussed, or anything that we should be nervous about that people aren't talking enough about?
Yeah, no, I think the most important message really to investors is just stay invested, but also be diversified, right? But there's a fluidness that obviously sometimes there's an advert that I'm always seeing on Bloomberg these days that a guy is trying to remove his appendix and they're saying you shouldn't have done that. There's a doctor who can do that. So don't try to do things that you can't do. So investors should really put some of their responsibility for investing into the people who are trading the market, studying the market, understanding what it's doing. That helps really with just the diversification, the placing within asset class choices, sector allocations, because even if we get a recession, there are places where you can be that can be beneficial. We have seen 1999 dot-com bubble, we have seen 2007, we have seen 2020, we have seen 2000, huge drawdowns in the market. But if you look now, average performance over 10%. So staying invested, I think, is the best way to go.
Thank you, Richard. I have one final sort of little anecdote I wanted to share with our listeners. I was reading a well-known UK paper the other week, and the article said quote, with inflation declining so rapidly, why are prices still rising? And sometimes one needs to be very careful of the quality of material that one reads in the press, because inflation is by definition something that goes up. So even if something is going up, is at a lower number. And I say this simply to observe to listeners that if you start to see signs, headlines saying inflation has fallen, that doesn't mean prices that you're going to be paying are falling. It simply means the prices you're going to be paying are going up at a slower pace than they were. Yeah. So what you see in the supermarket right now in general isn't going to get a lot cheaper. It's just going to not go up as much as it has been in the past year and a half. So I say that simply as a warning, because our topic was so much about inflation, and there was this, and I say well known, I don't mean a trashy UK paper. It was what might be called a broadsheet, so arguably supposed to do no better than that. Look, that unfortunately, as always, means that we are at the end of our show. We've had great conversation, but time is limited, as it always is. So Rich, it's been an absolute pleasure having you on the show. Thank you for joining us. Exactly 12 months to the day from when you were last with us. Let's make it less than 12 months the next time, if you would.
I agree. Thank you, Simon. Thank you for having me.
My pleasure. Look, a final note for listeners. This year's Cayman Investment Forum is going to be at the Kimpton on the 2nd of November. The topic is change, and we have an exceptional array of speakers, from a renowned behavioural economist to a professor of robots, talking about the future of humanity. Keep your eyes and ears open for registration opportunities. And then thank you to all our listeners for tuning in to Money Sense once again. Please do rejoin us in 2 weeks' time.